Good morning, everybody. My name is Dan Hussey from Zaner Ag Hedge, bringing you the Strategy of the Day update for May 20th, 2020, 5/20/2020. Man, if you had told me a couple years ago Donald Trump would be president the same year that the Cubs would have won the World Series, and just a few years later some bat soup would have sent the entire world and global economy into a world's headspin, I would have probably laughed at you, but that is the world in which we are living, and what a timing everything has been, right? So let's get going here today. I want to really focus on a little bit more on the US dollar because we've been in a tight trading range, and the dollar is really, in my opinion, one of the only factors holding back US export markets at this time. We're starting to see some news out of China. Today we had them selling off. Let me see here. It looks like they started their, yes, China will sell 4 million tons from their state reserves of their corn, state reserve corn, on May 28th, as weekly state corn auctions will begin. Corn futures in the Dalian fell to the lowest levels in almost 2 months as the market awaits auctions and imports. So the Chinese government is starting to auction off their corn reserves because obviously their own corn, production is down to eating away at reserves, and their import markets have obviously slowed down. So this is a way of hey, in anticipation of imports and trying to keep corn prices low, so their producers and their effectively their livestock markets are able to get cheap feed, and their ethanol production is able to get cheap grain for ethanol. But we are seeing those auctions pick up, which kind of flies in the face of the hopes that we will see them pick up imports, but from the United States. But that is the reason it happens. So this comes alongside, expectations of imports, because now China has to rely on storage, their stored grain, and we're seeing that. So last year they sold a total of 22 million tons from the state reserves, which lasted for about 5 months. So they still need to source 25 to 30 million tons of corn to last them the rest of the year, and that is something that we're going to be, starting to see, and that's just from their reserve, stockpiles. But what does that mean for the dollar? We'll get into what corn, wheat, and the beans are doing here today real quick. I guess let's just go over those real quickly here. So yesterday's outside price action and continuation up in a series of higher highs and higher lows on the daily candles. That, again, if you're looking at my charts, this blue and red dotted lines, those represent the highs and lows for the month. The blue, the light blue, and the magenta lines represent the high and low for the day. And then, of course, this would be a 4-hour candle that we're looking at for the July corn. There is a trend line against the lows that continues to hold and has found support here today, really range bound in trading markets. But if we go back and you analyze the trend we've seen, you've seen a couple days of uptrend, a couple days of down, then a couple days of uptrend, 1 or 2 days of down, couple days of uptrend, 1 or 2 days of down, and until we really get a breakout and you see substantial momentum higher, that would constitute a true reversal. This does look very corrective in nature, and it worries me that it isn't just one of these corrections sideways that we've seen in the past, for a few week period before ultimately a big sell-off resumes. The things that we have that we're optimistic about right now is anticipation of Chinese demand. We're seeing strong exports from countries like Mexico, and that continuation maybe into tomorrow's report will be important to see. And again, we're starting to maybe see some signs of the dollar finding a top and maybe starting to weaken. It is still very consolidative and sideways, the US dollar is, and we will take a look at a chart of that in a minute. But for right now, we at the very least have grain markets that are trying their best to find a low and find support, at least for corn and beans. So corn still very sideways. Again, we break below trend line support. We go below the lows of today, which we've already seen a little bit of a reaction off of. While we're waiting for that, okay, there we go. Our intraday candle here, we're showing, what looked like a nice open, and then some selling pressure right on the open down into a new low for the day. We are below yesterday's close, which is up around the 821 area. So there's kind of, I don't want to call it an open gap, but I would like to see us get back to those levels at some point. We did test into them in the overnight, obviously. But we are still holding the trendline support. And in the very short term, if we can push back above 320, reestablish above 321, I'd say this was nothing more than a blip on the radar here in the short term. But generally speaking, corn does look like it's rolled over a little bit. We've come off of the highs of May. We're still in sideways to up price action. I wouldn't call this a downtrend per se, but that downtrend will resume if we start to break support and head lower. We'll come back to corn in a little bit and talk about maybe some of the longer term forecasts if we have some time, but I kind of want to move on and take a look at each one of the grains real quick, and then take a look at the U.S. dollar, because the dollar, again, we haven't looked at it in a while, and I think that's an important chart to look at. And you can see that this little chart on the right here, I've got it up, and it's a very big, I know kind of might be all over the place here today, but it's a very big range that we have going back from 2002 all the way on the left to 2019, 2020 on the right, and we'll take a look at what that means in a moment. Soybeans have been in sideways to up price action as well. We have reestablished and continued to hold the series of higher highs and higher lows for the beans. If you remember yesterday, we had the corn market making that higher high and holding higher lows. We did retrace into the end of the day some back and fill price action that today feels like we got a little overdone, which, that was the other thing I wanted to show everyone here today. The reason I'm not super worried about corn's pullback is because if we use some little bit of statistical analysis, where we've been over the last couple of weeks has just been kind of in this range, right? And if we consider that, okay, if we're just bouncing up and down in this range and maybe trying to make a little bit of progress to the upside, we've had a daily range that's been pretty consistent here. If you look at the corn market here, a daily range here today, of about 4 cents, I'd call it. You can see almost every single day has had that exact same range. The days that were maybe a little bit more than that were about twice that range, and that's it. So we have this increment that the market seems to be moving in. It's testing price on a day-over-day basis, almost mathematically and algorithmically, right? Well, I wasn't too worried about this pullback in the corn, because all we've really done was we did 2 steps forward, and now we're doing 1 step back. So, and actually in this case, this was more like 3 or 4 steps forward, and here's your 2 steps back. This, while it wasn't into full 50% retracements, if you draw from, well, actually maybe it is. We might actually be starting to defend the full 50% retracement from low to high here, and there it is. Low of the day so far actually is the 50% retracement of the entire rally. This is very dirty. I wouldn't call this, if you're an Elliott wave person, I wouldn't call this, anything more than a correction just yet. But the reality is we're starting to make progress on the chart, and we are starting to hold, support and defend support. Until that support gives way, we're seeing indications of why maybe other markets like soybeans are finding support, and how, if they give way at resistance, how that might lead to that price rally to the upside. And that's where looking at the commitment of traders, taking a look at how maybe the market is starting to how the market sentiment is starting to shift could also be important. But yesterday, when we had that back and fill price action on corn, soybeans also had a pullback, but they were unable to break the prior day's low. So we still maintained higher highs here day over day and higher lows day over day for soybeans, all the way, continuing now into today. So this is the 4th day in a row now of higher highs and higher lows for soybeans, and taking out the 850 area, I think this time up will be met with a rally towards 860, and then now that will be the 4th test of 860. And I've never heard of 4 tests really holding. It certainly could. I don't want to be jinxing it at this point, but the next push up above 850, probably going to go above 860 in my opinion, given the way that this market has built up all that potential energy while in this range. Now it's built up stops. There's traders with stops at 830. There's traders with stops at 860 now. It goes through one of those two levels. Those stops will be that potential energy and be the fuel for the fire that creates either a short covering rally, in my opinion, or a sell-off down into new lows. So below 830 probably leads to $8. Above 860 probably leads to 880, 890. Again, no perfect given opportunity here, but we do have sideways to up price action. A couple days of higher highs and higher lows, and what looks to me like a market that is the proverbial, if you pull the rubber band back, the further you pull it back, the further it will fly type of look to it. So unless we roll over and we dip below today's low at 842, yesterday's low at 838, and we continue this pattern higher, market looks geared for an uptrend and a reversal. And now for wheat. Hey, wheat showing a little bit of an outside day reversal to the upside. I still think we need to get back above the 508 area that was the highs from a couple days ago to really constitute a good reversal. And of course back to 530 to retake the highs of May here, because we did get battered down. But putting in a bit of a double bottom here into the 490 area and not wanting to spend but just a moment below $5 is a good look. Now, things don't look that great for wheat in terms of technicals on a chart, but the fundamental picture for wheat is starting to look much better. The US dollar is down, and we will look at that here in a moment, but we are down in the Dixie on the June contract today. It is trading, wow, down 29, down 30 here, trading at 99 even last. We'll take a look at how that is down considerably, and it was actually down a lot more, and that could help again boost those exports, because a lower currency or a weaker US dollar gives foreign importers, people buying our grain to import to their country, more purchasing power, and that is such an important idea to understand and realize drives the export market. Okay, so wheat, there is a daily chart up here. Range here, again, we've talked about this between 580 and 480. Call it a dollar range that we've been in. Well, we found the low end of that range. We dipped below it. We had, in my opinion, what looks like now a bear trap forming. And if we can continue this bit of short covering rally that we've seen here, I do think we'll start to see a substantial rally back, at least to test the highs of May, which would just be reversion to the mean, be reversion of half of this decline from 570 down, be back towards the middle of the range, all the good stuff. Wheat right now, Minneapolis wheat is a record net shorter, was as of May 15th here. Corn is short negative 188,000 in the non-commercial. And that's as of, again, last Friday, which these are very delayed. So, we've probably seen more shorts build, and soybeans are actually net long in that non-commercial, but yeah, we'll talk more about that later, I guess. But some of those shorts in the corn, in the wheat, might need to start coming out of this market. There's not a ton there though for short covering rallies, but to ensue off of. But we'll see. There wouldn't take much to reverse the technical picture on this wheat chart. And we know the fundamentals, if the dollar starts to turn, that's a positive. But more importantly, we've got low planting, lower yield expectations now from some crop tours that occurred over the last few days, and slowdown in exports from other wheat markets. We've also seen a bit of weather issue hit Australia now, which is going into their key season. And that's what's another important thing to remember, is that while there's another harvest for wheat every few months around the year, a lot of those markets are being faced with their own issues that they're struggling to meet demand with. And in a year where we have such low production in the United States and arguably very tight stockpiles, it's going to be interesting. Obviously, there isn't that fear and that demand for wheat, but if we start to see a little bit of a technical reversal here, caught a sneeze there. Seeing that there's a bit of a technical reversal, breaking of trend lines now, and the potential for this market to move back towards a test of 528, we've got at least the fundamental picture that helps support that somewhat. But without further ado, let's take a look at the US dollar. We're going to take a look at the Dixie. I'm not a big fan of the dollar index because it is only a small fraction of the full dollar's value. It actually doesn't even take into account our biggest trading partner, which is China. However, it is a good barometer for where we rank up against the G8 currencies and some of the commodity currencies globally. It is very weighted towards the pound, very weighted towards the euro. Over almost 60% of it is in fact the euro. Then the pound and the Oz and the yen come in. So there's a very strong tie to our fixed income markets because of the tie to the yen there as well. Without further ado, I have a daily chart up, a daily continuous chart up of the dollar index. And you can see we have been stronger in the dollar, but we got to go back to about 2000. The year 2000, 20 years ago, to see those levels again. And here we are banging up against what to me is this 100 level was an old threshold that the market really had a fight to get above. If you go back and you look from the 90s into the 2000s, it really was a fight about breaking above $1 or the 100 area on the dollar index. Market traded up to about 120 into fears the first European and during the dot-com boom or bust, I should say, and then the dollar weakened. We had a period of Fed accommodation, monetary policy, and a reversal off of that dot-com bust into effectively the recession. And during the recession, the dollar was actually at fairly weak levels, and the Fed, it was very feared that the dollar would fall apart. That we would lose all faith in the dollar as a global reserve currency. But the Fed nevertheless acted, quantitative eased into infinity. And interestingly enough, the period that followed for the US dollar was actually one of the strongest periods for the dollar in recent history, and certainly led to the dollar rallying back above or back to that 100 area. And until this current recession, we were above a buck there and have been above 100 again. I got to stop saying $1 because it's not. But been back above 100 here in the near term. And you can see how for the most of 2018 and 2020 through 2020, the dollar's gotten stronger, which has been a big reason that China has been so tough and using the rhetoric of when market conditions apply on their on their purchasing of U.S. ag products. And it's because this dollar has just been getting stronger in them. And the stronger it gets, the more expensive it gets for China to buy our ags, regardless of what the price is of the underlying commodity. So the price of corn could be $4, but if the currency moves, all of a sudden the price of corn to the Chinese could be $5, but to us it's still at $4. And that's the thing that changes, that can really affect global markets and those global export markets. But in the near term here, we have seen some volatility in the dollar. And now we're starting, in my opinion, I think we're starting to find a bit of a topping mechanism in place. And if we really can break below the lows here of this range we've been in between 98 and 100, I do think we'll be testing back down to 94 in no time, and retracing back down in the range we've been in, back down to 88, and that would give us I think a solid boost to export markets. We've already seen some decent exports given all things considered. Exports aren't great. They're good, they're not great. They're great all things considered, but historically they're terrible. However, we've seen some really big exports over the last several months, even in the face of tariffs, even in the face of a strong dollar, and that says something about global demand for grain, global demand for U.S. commodities in general. And I think that once the world sees itself through and starts at least pricing itself out of COVID, which I think is starting to happen given that markets like crude oil are now trading up again here today. Might as well jump over and take a look at the crude real quick, because it's gonna drives a strong correlation with markets like corn recently. And actually today they interestingly enough, here I'll pull that chart over, don't worry. Interestingly enough, today there is a bit of a break in that correlation. We see corn actually down on the day, right, somewhat, with crude oil up. And I would assume in one of these two, and I'm guessing it's corn, will come back up to meet crude oil, because you can see there's generally been a pretty good correlation between these two assets over the last couple months, because again, they're trading with a lot of fund flows and fund money that goes into them, but two, because corn is effectively ethanol. 40% of our gross production of corn goes to ethanol, and so 40% of corn price follows the price of energy products like oil, and that is something that gets looked at in the market. So there's also so we will be anticipating, if the dollar, and we're going to continue to watch this here, if the dollar can continue lower, if it does continue to roll over and break back down to the range we've been in, that's going to help boost those imports. Or, I mean, it's not a direct effect, right? It will at least help with incentivizing those imports, because it doesn't have a direct correlation, right? Just because the dollar is weaker doesn't mean China is buying, but it is the market condition in which they're looking for. So, all right, everybody. Well, that about wraps up this morning's look at the markets. We're going to be continuing to watching the dollar here. Again, we really, really want to see a break back down below this 98 threshold, push the dollar back into the range we were in. That would, I think, be the icing on the cake for what is otherwise a genuinely good-looking, global picture for demand. Assuming we all make it out of COVID alive and restart the economies is really the important thing. And when I say we all, I do mean that the gross majority of the GDP producing populations of the world. Flu season will pass. This pandemic will be behind us, just like 1918 was. And there will be some normalcy that comes back to the world. It'll take time, but I do think that markets, like I said, like crude oil here, are starting to maybe price in what is crude oil's price after COVID, and we're already starting here. I'll bring up the daily chart of crude. We're already starting to climb back up into the range, and again, if we could get back up to that $40 a barrel area for crude, that would close some gaps on this chart. Maybe drag corn, in my opinion, should drag corn up to $350 to $360 a bushel, but who knows? We'll see what happens. So with that being said, everybody have a great day. We'll be back with you as price action develops. You can always get a hold of me, chat marketing, talk about some trade ideas, and see how these might fit for you. Remember, trading futures involves risk. It is not suitable for all investors, and leverage can work for you as well as against you in the futures market. But everything I've talked about here today is just my own opinion and not a direct trade recommendation. But if you do want to talk about some trade recommendations and what I could do or what Zaner could do for you, give me a call, 312-277-0110. That's 312-277-0110. Shoot me a tweet at Daniel Hussey Jr. on Twitter, Facebook, Dan SOTD, and of course, you can always email me, dhussey@zaner.com. Have a great day, everybody, and we'll be back with you later today and tomorrow. Join us as Ted Seifried from Zaner Ag Hedge Team. He's our chief market strategist and the captain of the Zaner Ag Hedge Team. Will be with us to chat about export markets, talk about the grains, and give us some of the early mid to mid-spring forecasts from what we could be expecting. So take care, everybody, and we'll be back with you tomorrow.